Thanks everybody for attending. My name is Tom Kessiglu. I'm with Ice Miller. I chair the private equity group in our New York office, and I represent capital providers and independent sponsors in investment transactions. We have a really strong panel today, and the title, Implementing Creative Structuring Solutions to Push Deals Over the Line Amidst Economic Uncertainty. Hopefully the interest rates at 2 o'clock today go down, which will help with the economic uncertainty. What I like to do is go down the line and have everyone sort of introduce themselves, give their 30-second elevator pitch. And just to sort of frame it, we have 4 capital providers and we have 1 independent sponsor who I think we're going to gang up on somehow. But I'll start with Sam.
Sure. Thanks, Tom. Sam Snyder, managing partner at Grey Rock Capital Group. We're a junior capital-focused private equity fund. I sit in our Walnut Creek office. We also have an office in New York and Chicago. Backing independent sponsors is core to our strategy. We've done 38 platforms and are eager to do more, currently investing out of our 6th fund. I think I got on this panel because we just hired Tom's firm for our latest deal. Really excited to work for Ice Miller. They've got a great reputation.
Happy to be here this morning. Good to see you guys. Rob Kissling, I'm with Source Capital, Atlanta-based firm. We actually were founded 22 years ago as an independent sponsor ourselves. And so that strategy and evolution eventually led us into our secondary strategy where I sit, which is our credit practice. So we founded that 13 years ago. We're an SBIC fund. We just got our license for Fund 5 about 3 months ago. So it'll be about a $300 million fund. Independent sponsors, similar to what Sam said, are core to us, obviously given our ethos and our background as being one ourselves. So we've done about 19 independent sponsor deals in Fund 4. We did that over a span of about 3 years. We've done 2 already in Fund 5, and we're signed up on 4 more. So certainly excited to be here and get a chance to share some thoughts with you guys.
Hey everybody, Jay Sprague. I'm with Tamarix Equity Partners. We're based here in New York. Tamarix was founded in 1993, and the focus all along has been first institutional capital into founder and family-owned businesses. We have a lot of experience partnering with independent sponsors to invest in businesses with 4 million plus of EBITDA across a whole range of traditional middle market categories. Currently deploying capital, excited to continue working in the independent sponsor space and look forward to meeting a bunch of you and happy to be here.
Hi everyone, I'm John Barnes from Star Mountain Capital. I'm based here in New York City, as is our firm. We're a 14-year-old firm that is private credit focused. So we're a direct lender as well as a very frequent and sometimes substantial equity investor in a range of industries with a focus on the lower mid-market. We manage $4 billion of capital across our flagship funds, our SBIC fund, a private BDC. We also have a secondary strategy that's distinct from our direct strategy. I have worked with independent sponsors on numerous occasions. We back independent sponsors frequently, and I look forward to meeting you all today.
Good morning, everyone. I'm Brian Rand. I run Rand & Co. Holdings. We are an independent sponsor, but we operate as through a holding company model. We've got 9 platforms where our companies are kind of across industries and geographies. Our strategy, I've worked with many folks in this room from Sylvie and in the same building as all the Atlanta folks are all here. I'm based in Atlanta. Looking forward to kind of sharing a little bit of perspective on what it's like on this side of the table. And I know we want to hear from the capital providers, so they're well represented, but happy to kind of share what it's like on the other side of the table. Happy to be here.
Great. Let's get into it. So first question I have, and this will go to the capital providers. So not all independent sponsors are created equal. Some have a lot of experience, and some are just new to the game. And I'd like to understand everyone's approach, and given the economy today versus, let's say, a couple years ago where it was much more robust, whether you take a different approach when dealing with these independent sponsors. Are you structuring things differently? Are you more inclined to, and don't mean to say this in a bad way, but more inclined to take advantage of those who are new to the program or new to this, as opposed to someone who's much more sophisticated. So, just throwing that out there, I'd like to see if who wants to take the first stab at that.
Happy to do it. So you kind of hinted on either the profile of the sponsor or the structure. I'll take the profile piece. At least from Grey Rock's perspective, we look at, I'd call it a spectrum, where on the one end of the spectrum, you have very traditional M&A, private equity background. Maybe it was a middle-level private equity professional that spun out of a fund because partner track wasn't there, or wanted to get to working on smaller deals because their fund upsized. But it's a private equity professional who's done critical mass of deals and just knows the process and has a track record. That's one end of the spectrum. You go all the way to the other side, it would be operating executive, maybe had been a CEO of the sector of in the sector of interest or the business model of interest, public company CEO, whatever. Maybe has some M&A background if they led a business that made some acquisitions, but generally that's not the strength. The strength is actual direct deal value add, looking around corners with the business. We'll look across the whole spectrum. As long as you've got a great LBO candidate that meets our kind of fundamental criteria, if we can get an independent sponsor on that spectrum who also meets our, we look at each of these deals as a marriage. We want to get along philosophically because our average hold period is 7 years. That's a lot of time. In some instances, you're probably spending more time with us than your significant other. If we can align on philosophy, have fun working together, we'll look at anybody along that spectrum, which doesn't really vary with market conditions, at least not that we've seen over the last 20 years or so.
So you haven't taken a different approach in, let's say, a recession, or this is a slight recession, but
Yeah, not with the profile. On the structure piece, just so I don't hog the mic, I'll let my friends talk about that.
Yeah, I'm happy to hit on that. I'd kind of agree with you. We certainly would avoid certain industries, right? Given economic climate, highly cyclical industries are always tough for us, highly commoditized. We probably shied a little away from more consumer discretionary as of recent, just given some of the headwinds we've seen in the space, generally speaking. But, as I think about structuring deals and experience, I think there's a baseline of experience required, certainly, for us to even be interested in pursuing a transaction, given that person's obviously, one, going to be a partner of ours, and two, going to be the tip of the spear, really guiding their view and vision going forward. So it comes down to us, probably how much equity is coming in from them, how much they've raised outside of themselves. That obviously creates some inherent alignment around sort of incentives and skin in the game, at-risk capital. And then the other component to that is, depending on that level and degree of investment, that may dictate the type of governance that we think about. So, is it going to be a little more hands-off, board observation only on one end of the spectrum, or are we going to swing to the other end where, and we've done this in situations where we're a bit more turnkey, perhaps represent a control equity stake in the deal along with our debt. And something like that, we might have, a true traditional board seat and more probably onerous negative covenants around key decision-making and things like that. So that's probably the bigger delineation for us is, the type of investment assuming a baseline of experience and obviously a good person at back.
Okay.
I guess I would add, from the equity side, we're collaborating with an independent sponsor in these types of deals. And we're always cautious of cycle risk, but particularly in moments like this, that's a heightened risk that we're paying attention to. The way I see it, part of doing that well is really understanding an industry and where a company that we're looking at sits within that industry. So to the extent an independent sponsor comes with deep knowledge of an industry and can really help us diligence that part of the equation, that's obviously something that we value a lot.
Now, Jay, just to point out, you guys, and it just sort of dawned on me, you guys are much more equity guys.
Correct.
You're not filling out the debt capital stack. You're going out to a source or to a Star Mountain on your financing. So you're really filling the equity hole that independent sponsor has.
Yeah, most typically we come in either pre-LOI or after an LOI comes in, and we'll take a controlling equity position. We'll then collaborate with the independent sponsor in raising debt. We've worked with folks like Source on other deals, and we obviously have a network of people we go to fill out the capital stack beneath the equity.
Yeah, and John, just to get to you, you're much more debt oriented, and so interested to hear your perspective on this.
We are more debt oriented, but I think a differentiator for us is we can help that independent sponsor fill the entire capital stack, or certainly all the debt and a good portion of the equity. And just, I agree with the good comments already made, but I would just maybe add a little bit, which is to say we really underwrite the sponsor just as rigorously, or we try to, as we underwrite the deal itself, right? And that's kind of how I think about it, right? And the word alignment's been used already a few times, and it was used in the prior panel. It probably can't ever be used enough, right? How aligned are they with us? Skin in the game, and it's, as was said earlier, not just a rolled fee, but hopefully there's some cash equity going into the deal. Understanding it's probably not going to be a huge amount, but is it meaningful to that independent sponsor? And then how aligned is their expertise and their track record with the opportunity they want us to back them with, right? Have they invested in this sector before? Do they have operating partners that are going to be value added and maybe be board members alongside them? We just closed a deal where they had, a very strong realized track record in the exact same IT services world that we were funding, this independent sponsor's next deal. They also had an operating partner who was going to be chairman and had been chairman of similar companies before. Like, those things are really important, right? Are they the right buyer for this business? Does their thesis make sense? And have they kind of done it, hopefully, once before? And are they going to have skin in the game? So those are some of the things I think about as we underwrite the sponsor alongside the deal.
Right. And can I add something on the creative structuring piece, just to be direct and hit the panel? You hit on this a little bit, Jonathan. For Grey Rock, a big trend that we've seen in the deals we've closed, probably, 15 or so independent sponsor deals the last 5 years, we've seen a big shift to our one-stop solution. So with Grey Rock, our key value proposition for the independent sponsors, one check for all your equity or all the equity that you need, as well as typically or historically all the sub-debt or most of the debt. With what happened with interest rates, with what happens with market disruption, the first source of capital to leave the lower middle market, at least in our experience, is senior term debt. I think it is a terrible ROI for banks in good and bad markets. It's not that much more expensive than the term debt a big company would borrow, but a small company is inherently riskier, and so it makes sense that they kind of back away from the market when there's any uncertainty. We've had a much higher adoption of the sponsor wanting just us to do the entire deal. So I think 12 of those 17 deals were all just Grey Rock, one check. It provides to the seller, it's a kind of no financing contingency offer because there's no third-party debt. It's all, who they're talking to around the table. And from an independent sponsor standpoint, at least the creative structuring way we think about it is it might be modestly more in terms of cost of capital, but you really think about, okay, what's the net against that? I don't have the headache of having to manage my life around a senior lender who is much less patient, has stricter covenants, may not allow you to invest in the SG&A or go through, often which a lot of our companies go through, is an inability to get numbers on time for a significant period as you're wrapping your arms around it. So it's a pretty compelling structure, and it's been a stark difference and uptick the last few years.
Brian, so I imagine you are on the spectrum of a very sophisticated independent sponsor and having 9 platform companies. So I'd like your take on when you first started and the approach independent sponsors took to you at that time versus, let's say, today. Whether it's changed, whether it's the same, just curious.
Sure. Thanks, Tom. What I've seen it has been in line with the discussions we've talked about so far. That, I think the alignment piece, right? If I had a time machine and I could go back and talk to my old self, I'd say, beg, borrow, or steal, but your own equity coming into a deal just changes the conversation significantly. Take it from friends and family, go to your friends, tap dance, do whatever you need. But showing up and say, hey, I've got a deal under letter. I've spent my hard money on deal costs, and I'm good for $1 million. And every guy on this panel looks at you differently. And so, and again, maybe it's not your $1 million if you just haven't had the realizations yet. But my advice to anybody in this game, if you have a deal that you think is truly an unfair fight, you have a chance to create meaningful wealth for all of the stakeholders, including yourself and your family, bringing your own money to the table. You know, I agree with everyone on this panel, but I want to kind of share my experience saying that when people say they're underwriting the sponsor, I think it's absolutely true, and they care about your track record and where you used to work, and that's all great. Showing up and saying, I'm good for $1 million, probably outweighs a lot of that. And so, in my experience, and again, obviously, they want to see that you know what you're doing, but you're going to show that by having a quality deal, thoughtful underwriting, really identifying the risk, proving that you're not just a broker. That if I could go back in time, every deal that I did where I was just trying to roll the fees and all that, I would go back and say, go to friends and family, find some hard money, spend hard money on deal costs. People will look at you differently. I'm open to feedback, but that's been my experience.
I'd quickly add to echo something John said earlier. What's meaningful to one person might be different from what's meaningful to another. It doesn't necessarily, from our perspective, have to be $1 million, although that's great. You know, if it's a younger, scrappier sponsor, maybe they can't fund $1 million, but if something that's meaningful to them, they're willing to put on the line, it speaks to that same credibility, skin in the game, and sort of long-term commitment to the deal.
I'd add one comment to that. I thought the really interesting way to look at it, we've struggled with that and thinking about it probably 3-4 funds ago, and we did this analysis and we've kind of rolled it forward. You know, we've had 22 exits so far of independent sponsor deals, and what's interesting is that returns don't correlate with skin in the game from our experience, and we're slightly below end statistical significance, but the way we look at it is, you know, we're a fund. We want to put more money to work, not less, if we like the deal, if we like the sponsor. So that kind of duels with that concept. But, you know, depending on the group, I do know that some have a very big focus on, you know, you putting skin in the game. And I think it's good from an independent sponsor standpoint to understand the capital provider's sensitivities and what they're really focused on. You know, that's an interesting, we have a sponsor, they're kind of like I think they've been around 30 years, called Hanover Partners out of San Francisco. We've done 4 platforms with them. They have done so incredibly well, but they're just, every deal, they roll their fee and that's it. And it's just kind of their vocation, how they've done it, and, you know, all different shapes and sizes, but that's a very good point, and know your audience. You know, that's what I take from that. Yeah.
And Tom, just kind of my thoughts on what Sam's. I'm really more speaking to the independent sponsors in the audience who are like focused on getting a deal done, which there is a piece of it of like making it work. And I think the capital providers have certain considerations. I'm simply saying that, like, for those of you who have deals and you're green on hard costs, you've engaged Ice Miller, you've engaged your Q of E. That's what I was thinking too, but that's kind of my perspective. I hope that.
And Brian, I agree with that. I mean, we see this all the time, right? As the attorneys representing either the capital provider or the independent sponsors. And to your point, when an independent sponsor comes up with more money to the table, you tend to get better terms. Terms in terms of legal control, board rights, what are the consent rights, are there removal rights, does the management fee get taken off the table, does it not, that sort of thing. And maybe that's just my experience. I'm curious to know what everyone else's experience is on something like that. But I agree with you. If the check's supposed to be a $10 million check or $15 million, and you can bring $3 million of it to the table, and you're covering all the costs, and you're not asking the capital provider to sort of take broken deal fee risk, I think you're right. You come at a different. People look at you differently.
Yeah, I think you're absolutely right, Brian. I mean, I strongly agree, and Sam, I agree with you as well. I mean, know your audience, right? Know know what matters to the firm you're talking to, and that takes some iterations, takes some reps, talking to each other. But I think no matter how much money it is, I think source of capital also respect and put value on the sweat equity and the diligence already done and the focus and the kind of the depth of conviction, right? And there are other independent sponsors we talk to who are very smart and talented, but and perhaps it's frankly our fault for saying, hey, show us everything, but you get a lot of things early and you're willing to do a support letter and try to help them, get it across the line, but you end up seeing a lot of deals in a very early stage, and you don't get a lot of insight from the sponsor because they're very early on, so you can't really blame them. And then you kind of talk about the next one, and you learn kind of nothing that you've seen to date has ever closed, and it becomes a credibility issue, unfortunately, over time. And perhaps that's on us to say, hey, wait, just come back to us when you've got something that's real, that you can kind of show us you really understand in great detail. And but that is kind of the flip side of it. I'd probably rather see fewer deals that are a little further along. They don't have to be tied up in a bow, but they've got to start to prove out that this is the right buyer for this business, and this is somebody we would really create a lot of value with because they've already done some work, and we're going to do a lot more work together. And that gets people like us excited, I think.
So Brian, when you're in the market, you have a deal, and you're evaluating independent sponsors. My guess is you probably go to the people that already provided you capital, maybe. And how do you gauge the capital providers? What are you looking for in a particular capital provider as you partner with them?
Sure. I mean, I'm happy to share my experience. I'm sure there are people in this room with more experience and have done it differently, so I'll give one guy's opinion. I'd probably break that up into debt and equity a little bit different, right? That on the debt side in the credit underwriting, in some ways that becomes a rate and terms game, right? Like if I feel good about the credit story and I know what's going on, then I'm in a position to where like that's becomes a kind of cost of capital, and include cost of capital. I talk about kind of terms and what they're like to work with, and then kind of making a decision there. I have found when it comes to mid-market, single-digit EBITDA businesses, the equity is the harder piece to find. And so that's where I'm leaning in much more on, the actual kind of upside story and who that resonates with. In my experience, institutional, whether it's SBICs that have an equity slug, people who are really built to do this have been much better sources of capital than family office. That I have found a lot of my peers and friends say, oh, we're going to go to a family office. Those two words can mean a lot of different things. And the amount of fall down risk, I think, is often like deeply underestimated by my peers versus folks who are built to deliver the capital. But in my experience in family offices, they're still rich if they don't do your deal. And so, I think there's this perspective that they're they're going to save us, that they're dumb money. I have not found them dumb, and I have not found them super reliable. One guy's experience, no offense to any of the super reliable, super intelligent family offices in here.
I assure you, none of these guys are dumb money.
Well, no, I know the institutional guys are not, but the perception that somehow family money is not.
Anyone have a reaction?
Yeah, I mean, I think we've seen varying degrees on the family office side as well, to your point, Brian. To the end of the day, right, they don't have to do a deal, to your point, right? There's no fund requirement. There's no, investment period they're managing by. If they like the deal, they can do it. They can also flake out at the 11th hour. And so we've seen, I think, all those varying degrees around that specific component of the structure. So I think a lot of folks we work with are really looking for, obviously, certainty to close. The partnership angle is huge. And many of them, I would say, would shy away from traditional sources like banks, for example, in part, to take the other side on the credit. If things don't go well, they're the most inflexible humans in the world, right? They want to get out in the worst times possible. You can't get them out. Next thing you know, you're in a tough spot. So I know one thing we've done in particular to try to address that in part is moved up in the cap stack. And so we are effectively a barbell in part because we have that alignment in the equity. And so we don't want somebody else who doesn't have a similar alignment with us and our partner, the sponsor, to be able to really take over the business and dictate what happens in a downside scenario. And so we can partner, lock arms, and move forward in that regard. But yeah, there's certainly, I think, depending on the pockets of capital you're going after, some pros and cons for sure. But the cons on certain aspects of lending, I think, certainly outweigh some of the other aspects of maybe rate savings.
I can't speak to family offices, but I can speak to the committed managed private equity fund side because that's where I sit. And we're built to do our own deals, and that's fundamentally often what we do. Good, strong, independent sponsors like Brian come in, and they also have that capability to close their own deals, right? They need the capital, but it's a complementary set of processes and skills. And so I think what's important for us is when we start to engage with an independent sponsor, setting expectations early on who's going to play what role in this process during diligence, during the closing process, post-close, being very clear up front around how that relationship and partnership works is critical because they can do it, we can do it, and obviously when there's an independent sponsor who comes with a lot of experience